Well, I see here it's 7:54, it's the 8th of September, and I'm asking you the question, where is your 401k? Okay, so let's go through a couple of slides here. And looking back in the rearview mirror right quickly, just kind of orient you. Last 12 months, we've had some very nice public markets, positive returns, double-digit positive returns when you look at equity indices, fixed income, very nice returns that might surprise you given the very low yields you seem to look at every day in the newspaper, but the total return over the 12 months has been quite good. And then in alternative investments, positive returns there. Even our esteemed real estate types on the panel be pleased to see that the REIT index was positive for the trailing 12 months. But what probably fits your mind's eye is the most recent 3 months and year-to-date numbers, which for equities is decidedly negative. As we move into fixed income markets, still very nice positive returns there. And then alternatives, sort of a mixed bag, but things that jump out at you as our friend gold and the REIT index, which still shows a positive return year to date. So what is all the hubbub about that has the year-to-date numbers looking so gloomy? Well, if we look at corporate profits as a percentage of GDP, you can see where the trailing 12 months have seen their nice returns. And this is, if you look at the chart, it goes back in the series clear back to 1960. This is an unprecedented share of our total economy of corporate profits. It's amazing what happens when you lay off 14 million people. And so there's where equities are enjoying their success. If we look at the real growth in GDP, at least the GDP bogey has returned back to about 06, 07 levels, but as you can see, it's hardly a robust recovery. Now looking at the U.S. government spending and revenue as a percentage of GDP, and this is kind of a busy graph on the left-hand side, but the point I'm trying to make is the federal spending, which is sort of that brownish line in the middle. It's up to 28% of GDP, and if you think about GDP, it's corporate, government, consumption equals the total. As I always tell my group at Kanaly, it all adds up to 100%. And what we're seeing right now is government spending and corporate profits as a percentage of what GDP we are getting is at an all-time high. And so when you were listening to the Fed's comments most recently that you can't cut government spending in the near term without crushing GDP, this is precisely what they were talking about. In the next slide over from that, if you're looking at what the debate is about how much you can deficit spend, you can see that spending as a percentage of GDP on an annual basis is running about 10%. And as we all know, the general level of federal deficit to total GDP is running at about 70-75%. And so that's where you saw the debt ceiling debates centering around. So what else has the markets concerned? This is the spread between the overnight lending rate and LIBOR. And the series only goes back to about September of 10. But what it shows is the spike there in June of 10. That was the first Greek debt crisis, and what happened to the spread on overnight lending. This is, I guess, for Kanaly, this is Do Banks Trust Banks Overnight Index. And as you can see, the trend is not particularly good about what banks are looking at lending to other banks overnight. Now, if this series went all the way back to 08, it would pale in comparison to what we saw in the 08 spread. So we're a long way from Panicsville, but the trend is not particularly good. The next slide is Western European sovereign debt spreads over the U.S. Treasury, and I find this a very interesting slide. Despite all of the S&P downgrades of U.S. debt, the terrible debates we had in Congress over the debt ceiling, our credit is good. And our rates are going down on the 10-year U.S. Treasury. So that's not the issue, is it, in the marketplace about U.S. credit? It is the spread between us and our European friends. And so that particular trend is not particularly good. And quite frankly, when we get up every morning at Kanaly, the first thing we're looking at is how are the European markets doing overnight, what's going on there, because that, we believe, is really the source of present troubles. Here domestically, manufacturing's hit a soft patch. We did have a nice ISM number just, I believe it was yesterday, which was above 50, which shows it's still expanding. So we're still limping along here. And so generally, I think the impression I want to give you domestically is our economy, while not robust, is okay. And your troubles are really not here domestically immediately. Jobless claims, they're moving below 400,000, which is another good indicator. So we're pleased with the direction of the jobless claim readings. But here's your real trouble domestically, and this chart takes a minute to understand, but generally in recoveries, you see employment bottom out and begin to move. In this series, it's all the recoveries since World War II. So you see the average in the orange line of job creation since World War II, but in the blue line, you see our present circumstance. And this is sort of a classic for a charter, a dead cat bounce. You know, if you drop that cat from a high enough place, it's going to bounce a couple of times there. And so we really don't have the employment recovery that you see in most cycles. One good piece of news, evidently you all are doing a very good job about paying off your credit cards and your home improvement loans. So household debt service ratio is coming down. We're getting very close to levels we haven't seen for quite a while, going back to 96, 97, something like that. So this is the ratio of debt in your household debt service. So this is pretty encouraging here. Here's the S&P 500. So this fits sort of your mind of, you know, what's happened to your 401k. We've seen quite a pullback here, and we believe it's due to influences abroad. Commodities have had a nice run up. You can see the real surge after a lot of the Fed actions really encouraged commodity purchases. We have a position in commodities at Kanaly, but we let it go about halfway through this year. If the soft patch continues, we think we'll see better prices in commodities eventually. So here's your big trouble. Here's the total debt to GDP. You can take this data series back as far as you want to, and you just don't have a phenomenon like this. And this is total household debt, state and local debt, and federal debt as a percentage of GDP. And that's really sort of the source of the trouble. So in going forward and whatever we might hear tonight from the President, if we're going to do something about our debt to GDP ratio, there's just three places it has to come from. It's either going to be a combination of defense, Social Security, and Health and Human Services, Medicare, Medicaid. And the percentages are just too large. It's where you have to attack the problem. You simply cannot cut it from the other areas. And at Kanaly, the view is that the Federal Reserve has done what it can do. The system is incredibly liquefied. The money's there. That was the discussion at dinner last night. Everybody agreed the money was there. It's reflected in interest rates, but it is a policy problem. We view at Kanaly, maybe not the whole panel, but it's a policy problem going forward that we need to hear from before capital gets unlocked. There still is a credit extension problem. There has been a few more commercial loans here recently, but compared to history, the lending rate is nothing like we've known in the past, and it's still one of the big problems, but that probably stems from policy issues. I'll bet you Mr. DiAgostino might talk about regulation. So what do you do with your 401k? You get ultra diversified, and you do it today. And you think about not only stocks and bonds, but you think about what we call alternative investments, and it includes things like gold, I'm sorry to say, but maybe not today at these prices. But it includes things you haven't thought of before, perhaps even MLPs, and that's what you need to be doing. This is not August of '82. We're not there where we can just buy and hold and go on down the road. We need to be actively managing our portfolios. This is sort of a quick slide. Y'all can look at it after the presentation. I know the fabulous Boyer and Miller website will have this, but this gives you an idea of the type of portfolio deployed at Kanaly versus a traditional 60-40 mix, and it's going to yield the type of risk-return relationship we believe you should be experiencing in your portfolios. And here's a quick slide for you all that kind of gives you an idea of how it's behaved during the last month and year to date. So the whole goal of the portfolio is to reduce risk and provide a stable return. It's to get compounded returns is what we're after.